Hello and welcome to the OANDA Market Pulse charting analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Now today we're going to focus on your European instruments. Of course we had the ECB meeting earlier on today. Just give you a brief overview of what the takeaways were from this. There was no change in interest rates or asset purchases, which was in line with expectations. We were expecting some dovish comments from Mario Draghi, but his comments were far more dovish than actually I think people were anticipating. Very direct, very clear in his message, repeatedly mentioned March when they're going to reevaluate their position, constantly highlighting how much has changed since the last meeting in December, how oil prices have fallen by 40% since, how they're going to have to readdress their position as a result when they release their next macroeconomic projections. Of course, like I say, that meeting takes place at the start of March. It was very clear indication that there's going to be more monetary stimulus in March. Now the only question I guess remains is how much is there going to be, and how are the markets going to position themselves ahead of this, given the fact that they positioned themselves very heavily for some strong monetary stimulus back in December, only to be disappointed with a meagre 10 basis point cut to the deposit rate and a small extension to the quantitative easing program to March 2017. Now, let's start with euro dollar. We'll cover euro dollar, euro sterling, euro yen, and the DAX today. Like I say, these are the instruments that we covered back in the videos on Monday that I would have expected to see the biggest response to the ECB meeting. Now, initially we did see a strong sell-off in the euro. Now that is not unexpected. This very dovish rhetoric and talk of further stimulus tends to be quite bearish for the euro. Now, what is interesting throughout this is, despite the fact that we did see this initial sell-off, of course, like I say, big sell-off here, about 100 pips. We came back to these 108 levels, and once again we did run into support here. Now, what's interesting since then is we haven't seen that second wave of selling. Now, this could suggest one of two things. One, of course, being that this 108 level is once again heavily supported, and that the markets are happy or content with the trading range that the euro-dollar pair currently finds itself within. It may also suggest that people aren't convinced that Mario Draghi has the ability to carry through what he's effectively hinted at, given again what happened in December. And it may also just be a case of there was such heavy selling initially that the markets are just in correction mode right now, and we will maybe see another wave of selling either later on this evening or early on tomorrow. Now, the correction that we've seen in this particular pair would potentially suggest the latter. We are seeing it pull back towards these 108.50 levels. Now, 108.50 or around this 108.50 to 108.60 is prior support for this pair, so it'll be interesting to see if we do see a reversal off the back of these, and if we do see some more pressure back on this 108 level. Like I say, this is a very established trading range, 108. If we do see this broken in the later hours of this evening, early hours of the morning, then I will be looking back towards these 107 levels. Again, I highlighted on Monday, 108.10, 108 to 110 appears to be the primary trading range for this pair, but when we do see an occasional move outside of these levels, then it tends to be 107, 111 tends to provide that additional resistance along the way, and this is really where we've traded in now for the majority of the last 2 months. So it will be interesting to see if the markets do move out of these boundaries in the coming days. My personal bias would be to the downside, because I do think the markets have been caught slightly off guard with just how dovish the rhetoric was from Mario Draghi, which would tend to be quite bearish for the euro. Caught off guard, but again, not entirely surprised given the turmoil that we've had in the market so far this year, given the 40% sell-off that Mario Draghi highlighted in oil since the cut-off period was done for their projections back in December. So it wasn't an enormous surprise, but I think it was far more dovish than they were anticipating, which may weigh on the euro in the short to medium term. Let's look at euro sterling next. Now, this was interesting because of really where this reversal happened. Already yesterday we did have a reversal off these 77.50 levels. Now, again, as I've highlighted previously, this is a prior level of support, so potential level of resistance. Now, we did see a reversal off this level yesterday. We saw the long upper wick form, which again is quite a bearish signal, and it also ended the session below its opening level. So we saw this kind of shooting star candle, but with a larger red body than you would typically associate with a shooting star, but still very bearish. Now, we saw this long upper wick again today prior to the ECB press conference, and again this has been reversed in another red body today. Again, not necessarily really a shooting star because it had got a larger red body than you would normally associate with such a setup, but the message is still very similar. I still think these are two quite bearish candles. I think the next key test for euro sterling now is going to be this 76 level. It carries in around between the 50 and 61.8% retracement of the move from these lows. Again, we'll have to bring up a lower chart just to highlight where this fib level has been drawn. So it's of the move from January 14th lows to the January 20th highs. It coincides with the 61.8% Fibonacci retracement level here, which has provided support on these two occasions. It's also a prior level of resistance. Again, now I'll just scroll back out to the daily chart. It is prior resistance as well back here early on in February 2015 as well. So again, this could be a notable level of support. If we see this broken, which to be fair, given the last couple of candles, looks possible, then we could be looking at a much bigger retracement, at which point, given again the significance of the move that we've seen in this pair recently, we could be looking at a far bigger correction, potentially back towards these areas here, the 73.50s to 74.50s, this 38.2% and 50% retracement of this entire move. Now what makes this interesting is that would potentially get a retest of this descending trend line, but probably more importantly, this prior area of resistance. We've highlighted this again repeatedly. This was a area that was previously support on the way down back in January 2015, and then throughout 2015, every time the pair rallied up to these levels, again between 74 and 75, it got rejected and sold into that. So once it broke above here, that was an extremely bullish signal back on the 10th of January, or around the 10th of January. So if we do see the pair pull back to these levels, it'll be very interesting to see how they respond, because if we do get a rebound off here, then that would be an extremely bullish signal, and we would also mark a correction in the pair, around 38.2 to 50% correction in the pair. So could be some interesting levels coming up. Euro yen is what I find particularly interesting, because we did see the initial sell-off in the euro, as we saw in the other pairs. Comes back to this 126 level now. Again, this 126 level I've highlighted already. Might be easier if I actually pick this up on the weekly chart. This is a very important area of support for the pair, because it has been a key level of support since April 2013. It's been tested on a number of occasions since, failing on each occasion. Now we've come back to this level today, and even though we got this very dovish rhetoric from Mario Draghi and hints at further stimulus in March, not only did we see profit taking at this level, we actually saw quite a significant rebound, and now we are actually trading higher on the day despite a very bearish euro message from the European Central Bank President. So I think this is quite an interesting development here. What this may suggest, it could suggest a couple of things. One, again, like I said with euro dollar, it may suggest that people aren't buying into it, but I think moreover, it's probably suggesting that maybe the pair is due some form of broader correction here, and therefore once we've got back to this level, there just isn't the selling desire at this level than there has been during the descent. Now, personally, I think we will probably see we could possibly see these levels broken, just going off the fact that we are clearly it would appear that we're going to see more stimulus from the ECB, but also the yen has been one of the better performing currencies over the last month or so. The risk aversion play clearly benefiting the safe haven yen at this stage. It may take a big push to get through this level, which wouldn't be a surprise given how significant a level it is. But again, I think this is one that I'm really going to keep an eye on, and I'm quite surprised to see the pair actually trading higher on the day. I'll be interested to see how this move develops over the next between now and the end of the week to tomorrow evening. Final thing I want to cover is the DAX. And again, no surprise that we are seeing the DAX trading higher on the day. It's currently up around 2%, following we did see a bigger response earlier on in the day to those ECB comments, and although it has pulled back a little bit since, but again, we are seeing it bounce off that level. It's a region which I've highlighted again on previous videos, because we saw the break of that very important ascending trend line. We saw a close below the trend line yesterday. But what I said is this gives us the indication that we're in for a broader sell-off. The confirmation for me will come from the break of this long-term support. Now, it should be noted that the DAX is actually already down 12.5% on the year. It's down 25% from its high. So we are technically in bear market territory here with the DAX, as we are with the CAC and as we are with the FTSE. But given the fact that the US indices are lagging behind, they're around maybe between 10 and 12% down now from their highs. They're not in bear market territory at the moment. They're still in correction territory. Maybe if we continue to see these losses in the US materialize, as I've highlighted on the previous charts, is very possible, then that could drag on Europe as well, and we could lead to further losses in the German DAX. But again, I think this level, this 90 to 50, is going to be very key here. Big level of support throughout 2015 and at the end of 2014 as well. And this could trigger further losses, potentially moving back towards these 8,300 levels that we've seen previously, with possible support being found along the way as well. So we could see some big moves forming again over the next week or two in the DAX, as well as in the other indices as well. Sentiment remains very, very fragile at this moment in time. People in the market are sounding extremely bearish, and while this may sometimes again indicate an overcrowded trade, it's so bearish right now that I would not personally like to be overly bullish at this moment in time, not until we see some clear evidence of some stabilization in the markets and of an improvement in overall sentiment, which would therefore benefit equity markets. Right now, people are talking very negatively about the equity markets and where they could go. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.